What's up, Empire Builders? Welcome to another video. In this video, we're going to talk about some more recession indicators and some more changes on the horizon. Now, this is something that, unfortunately, or fortunately, depending on how you look at it, is something that needs to constantly be watched. And so we've got some new information, some new data, and we need to talk about this. We're going to go through what's going on with some family centers and what the rich and elite are doing, stock buybacks, and a glimpse into what is going to become a looming problem in Miami. So this is actually a submitted piece by this Harry Kupperman, or Cuppy for short, and it's about the Miami market. Okay, he met and had lunch with a hard money lender recently, and I will summarize this for you, but of course you can go check it out for yourself. What's going on right now is that they are building an absolute shit ton still in Miami and surrounding areas. But the issue is that there is a lot of money in the streets still, and there is this growing race to the bottom right now. And it's not with, you got to understand something, like what happened in 2006 to 2008 was middle earners, okay? Middle class homes, which you can hit a recession and that stuff 5-10 years from now can still sell because there'll always be middle earners. And the concern this time around is that, we do have some influxes overall in the economic landscape. Like there's a lot more millionaires now than there was before. And there's really a growing divide between rich and poor, okay? That being said, there is an inventory of, estimated by this guy, which I think is a fair estimate, of high hundreds to low thousands of this 3,500 square foot style, not mansion, but condo that has like a pool on the balcony, and it's a $2.5 to $4.5 million house. And there's hundreds, if not over 1,000 of those backlog now. And the reason why this conversation was so significant is because now the whole thing is backlogged. The hard money lenders, which provide hard money loans for people who can't go to the banks and get money, that's their job, okay? And now they're starting to get backed up. We have people that are defaulting, and now they're taking on inventory, which they usually, most of them don't do. Most of them don't like to take on inventory. Some of them are structured in a way that, they're expecting that if you screw up and you dig yourself a bigger hole, we're going to suck up the inventory. But even those guys, they're not even able to really fire sale the properties or offload the properties quickly because the inventory is building up so high. There's just only so many people that are going to come and buy a $2 million or $2.5 million condo with a fucking balcony pool, and all the bells and whistles and luxuries, right? So, and it's a pretty good conversation actually. They get into the 50 base point cut. Did that help? Blah, blah, blah. Essentially it didn't. And so, yeah, it's a good piece. But what it's outlining is that these guys, it's bad on both ends, because you'd think like, oh, cool, well, they defaulted and they got the asset. Well, you still got to pay property taxes, which are an absolute shit ton. That could be $40,000 to $50,000 a year on a luxury condo like this, and they're getting very low returns on these, and they're just trying to offload them. So it's interesting. That's where we start. Next, let's touch on, if you've been following the daily emails, good, stay subscribed. I do cover some of this in today's email, but of course, we're talking through it now. So you get more of that insight, more of where my mind is at with this, because you can only put so much in an email. UBS surveyed 360 global family offices. Now, a family office is essentially somebody who manages money for the wealthy, okay? They do the estate planning, they do business planning, asset management. That's what they are, okay? And they surveyed 360 global family offices, which have an average family wealth of $1.2 billion. You could assume that these are ultra wealthy people, right? Survey results showed 55% of family offices see a recession in 2020. 45% of them are already adjusting their portfolios, including shifting to bonds and real estate, while 42% are increasing their cash flow. They're sitting on piles of cash. And this isn't the first time we've heard this, right? I've been parroting this for months now. Warren Buffett sitting on a pile of cash. You got entrepreneurs and many other people sitting on piles of cash, right? And we've been slowly covering that. So we got that piece, which is not looking good, because the reason why this is so important is, okay, let's say all this is true that we're talking about here with the luxury condos in Miami. And all of this is true as well, which this is true. I would just say this is the only thing that's opinionated is this Miami piece. That puts pressure on the middle earners because the ultra wealthy, which we talked about before, the one of the biggest art auctions, you could say, earlier this year did not do so well. Exotic cars aren't really selling that well, and exotic art really isn't selling that well either. So they noticed that there was, the $75,000 and less cars that were selling better and more than the premium cars and the luxury cars at these auctions. So there's a slowdown there. We got a slowdown and a pile up on the MLS in LA of the luxury houses and the custom houses, while they're still building more. There was 35 or 50 brand new custom fit homes, mega mansions being built, but yet there's 100 on the MLS. And it looks like the same thing. That's why it's not such a far stretch to think that the same thing is happening in Miami. Because look around, they're still building an absolute shit ton of new construction. And so it becomes a race to the bottom because even investors that are buying into those are trying to flip really quickly to the next sucker, because if the builder is sitting on inventory, then they'll just offload it for whatever price they can get. And that creates this, like I said, this race to the bottom. Now, you've got the auctions drying up, the ultra uber rich not spending money. It puts a lot of pressure on the middle earners. And the issue with the middle earners is it's like unemployment goes up by even a fraction of a percent, and it affects much deeper. It cuts much deeper than it would normally cut, right? Now, the benefit we have is we're coming up on holiday season and everyone is hiring right now for a holiday help, which is good because that should be a cash injection into the economy of sorts, and that should be a pretty positive thing. All right, so let's talk stock buybacks. We'll start here. There has been a record $1.1 trillion that have shifted out of stocks or equities into bonds this year. You'll see that corporate buybacks are on the rise, and it's one of the few things that are keeping the stock market alive right now. And if we look at times past, we see a slow escalation. And here's how 2019 is shaping up. So again, this is another piece to put into the equation in terms of buyback. So let's break this down. Global corporate have announced $820 billion in buybacks this year, which exceeded selling by traditional investors. That's supportive to the market as a whole. In addition, there is $1.3 trillion in pending mergers and acquisitions. That also supports equity markets. But a lot of that, like I said, that $1.1 trillion is running out into bonds. And we also have insider selling at all-time highs. So there's your buybacks. Do I have corporate insider selling? I don't. Okay. I thought I did, but I don't have that pulled up. So insider selling is also at all-time highs for this year. And insider selling, what that means is C-level selling. So we've got a lot of people taking profits this year. And then we have Microsoft for only the third time, 2013, 2016, and now this year. They're doing a $40 billion stock buyback plan. This was earlier this month. And they had a 12% jump, or 11% jump, after this news. And it rose by 2.8%. So the 11% increase was on the dividend side, and the 2.8% was on the intraday stock price. And I actually haven't really been keeping up with Microsoft to pay attention on that. But yeah, so that's interesting. And that's not a negative thing per se, but if you take that and stack that on top of all the other corporate buybacks for this year, it does start to add up and raise more questions, right? Okay, and I just wanted to pull this up really quick before we wrap up. Here is the insider selling on pace for a 2-decade high. Here's that data from FT, and I think I got one more here for you. Nope, that's the Fed repo. Oh, we do need to cover the Fed repo too before I close this out. Okay, corporate client buybacks. All right, let's now wrap up with an update on the repo. Okay, so essentially in a week or so, the Fed dumped in about $105 billion in cash into the banking system. Okay, a $30 billion inject, and then we had a $75 billion inject on overnight repos. Here's what that looks like. And so the concern is that these numbers haven't been this bad. The 10% that was reached, the peak that was reached on, I think it was like Tuesday or Wednesday, hasn't been seen since the global financial crisis in 2008. So that is a growing concern, and here's what that looks like. Quarter end repo rate. It remains higher than normal. and the Fed is, coming out daily almost and assuring that they have it under control. The BIS is giving other indicators. The BIS the other day, as I mentioned in the email, is saying that they're seeing recession, and the Fed is admitting that they don't have the tools, they don't have the ammunition if a recession comes. So this is getting pretty messy pretty quick. But what's interesting to me is that we are still hitting all-time highs and new highs in the traditional stock market, which we talked about heavily after the second inverse yield curve happened. We talked about, hey, you should be buying. If you're following the data, you should be buying right now because it's still time to be in this market and buy and sell. You just saw Microsoft. You could have clipped some quick profits off of that. Like in and out on these markets. This isn't positions that you're looking to sit on for the next upcoming years, because if we do see this recession and this pullback, you'll be able to get way better entry prices on a longer term position. But there's definitely been plays to execute during this market, and I still think we have time. I still think there is going to be, because through the end of the year now, as long as there's no government shutdowns and depending on what's now going to happen with this impeachment business, is we could still see highs again before the end of the year, which that all fits in the timeline of all the inverse yield data that we have from the past. So again, while a lot of the market, you look at your traditional economists, you look at a lot of the market screaming, oh my God, it's the end of the world. Is it? Not really. Profits to be made. And again, we're not talking long-term positions. We're talking in and out positions to make profit, right? So anyways, that's all I got for you. If you like this video, click the thumbs up, comment below, and subscribe and hit the bell notification if you're brand new to the channel. Okay, see ya.